Let's bring in Michael Kantrowitz, Chief Investment Strategist with Piper Sandler, and Komal Srikumar, President of Srikumar Global Strategies. Gentlemen, welcome. Michael, let me start with you. What do you see as the trajectory or the path of the markets and the economy over the next 6 to 8 months?
Hi, good afternoon. We've had the view for the entire year that markets are going to be range bound until we start seeing unemployment claims start to rise. I think we have started to see that. How fast they rise in the next couple quarters will be to be seen. Certainly, things point that direction. So, the next 6 to 8 months, I think markets are down, and we price in a hard landing, and that comes along with lower earnings estimates, wider credit spreads, and lower market multiples.
Let me understand. Rising claims would be good news because it would suggest that we're coming into or toward the end of the bad news?
Rising claims would be the worst news, as it is historically. It tells you people are losing jobs, and when job losses beget credit losses, beget further earnings losses, and that's what really gets you into a negative feedback loop. For the markets, that's a recession. That's a hard landing when unemployment rises. So that would be bad news. I think focusing on inflation at this point in the business cycle, in the tightening cycle, is really old news.
Yeah.
Sri, what about you? I mean, looking at it sort of cyclically with the same concern. And what about those who say, well, but the Fed, what is the Fed going to do here?
Two things, Kelly. First of all, in terms of where the economy is headed, the bond market has been giving a clear indication in recent months with the inversion of the 2 to 10 year as well as the 3 month to 10 year that we are headed toward a recession. And I'm looking for that to begin in the third quarter of 2024. In terms of what more could happen with respect to the economy, what the Fed may do about it, I believe that sometime soon, the Fed is going to pivot away from rate increases, first to a pause, then followed by a rate cut, at least a couple of rate cuts before the end of this year. Where is this coming from? Because inflation mitigation only takes on as a target, Kelly, as long as there are other problems which don't arise. We know that March 21st, 22nd FOMC meeting, the Fed considered pausing already because of the problems with Signature Bank and SVB. Now that we have continuing issues with FRC, my expectation is that even next week's 25 basis point increase in interest rates is not a given. If things worsen between now and next Wednesday, expect a pause. After that, Powell will probably tell us that he is going to still increase interest rates, but I don't think it's going to happen anytime soon after that.